So we are doing about purchase of a business by a limited company. That means a limited company is going to purchase a business. This business can either be a sole trading concern or this business can be a partnership firm. So the very first thing that you need to know is that if the company is going to purchase any company, the old company has to dissolve. So we are going to study first about limited company purchasing a partnership firm. So I would say the partnership firm has to dissolve. Partnership firm has to close down and the partnership firm has to dissolve. If in the partnership firm any partner has given loan to the partnership firm, then the limited company will convert the partner's loan into percentage debentures. Because limited company does not have this concept of taking loan from owners. So limited company will convert the partner's loan into percentage debentures. So what is happening is the very first thing that I need to know is that the partnership firm which is going to be taken over, that has to undergo into dissolution. The partnership firm has to close down. It has to close down. After the partnership firm closes down, all the assets of the partnership firm and all the liabilities, only those assets and only those liabilities which have been taken over, okay, it has to be transferred to the limited company. It has to be transferred to the limited company. The limited company is not going to take over the assets and liabilities at the book value of partnership. They may take over at an agreed amount. That agreed amount at which the limited company takes over the partnership firm is called purchase consideration. So let us see step by step what will happen if the partnership business is being taken over by a limited company. First thing, we will have to close the partnership. We will have to do the dissolution of partnership. That means we will prepare the realization account for partnership. All the assets we will write over here of the partnership. All the liabilities we will write here of the partnership. The assets and the liabilities are taken over at an agreed amount, and that agreed amount is called purchase consideration. So whatever the limited company is going to pay to the partnership firm will be recorded on the credit side of the realization account. This thing is the purchase consideration, however they are going to pay the purchase consideration. Then either the partnership firm has a profit on dissolution or they may have a loss on dissolution which will be transferred to the partner's capital account. Repeating again, what is happening over here? Limited company is going to take over. Limited company is going to take over the partnership firm. If my limited company is going to take over the partnership firm, that means the limited company is acquiring the partnership firm. If the limited company is acquiring the partnership firm, so partnership firm will go into dissolution. When it will go into dissolution, the first thing that I need to record is profit or loss on dissolution. The third thing that I need to know is how much money is the limited company going to give to the partnership firm for acquiring. So how much money the limited company is going to give to the partnership firm for this acquisition. That amount is called the purchase consideration. Purchase consideration. And third thing that I need to know is if any partner has given loan to the partnership firm. Okay, then what will happen? The limited company is acquiring the partnership firm, so they will convert this loan into debentures, and the limited company will issue debentures to the partner in lieu of the loan. Now let's see uh, how is this thing taken into consideration. We have a partnership firm. We have a partnership firm and the partner has given loan to partnership firm. Limited company is going to do what? Limited company is going to acquire the partnership firm. So limited company is going to acquire the partnership firm. Now since the limited company is going to acquire the partnership firm, they will convert this partner's loan into percentage debentures. And they will convert it into a percentage debenture. That means the limited company has to issue debentures. Limited company has to issue debentures to the partner. How much debentures they have to issue is the thing that we have to find out. Let's see over here. A partner has loaned the company $50,000. That means partner has given loan to the company $50,000. Interest rate is 6%. The company is taking over the partnership. It is going to issue debentures with an interest rate of 10%. That means the limited company is going to issue 10% debentures. Okay, but it wants to ensure that the partner continues to receive the same amount of interest. So the company is going to issue 10% of debentures, but at the same time, it wants to ensure that partner receives the same interest. Receives same interest. Let's see over here. The interest that I'm currently paying to my partner is 6% of 50,000, that is 30,000. So now I need to find out what is the value of debentures that I need to issue. What is the value of 10% debentures that I need to issue so that my partner is going to get 3,000 interest only. So how many debentures will I issue? I want to give him 3,000 interest only. So debentures, how many will I issue? So 3,000 divided by the percentage of debentures will give me the value of debentures to be issued. Just to be issued. So what is the value of debentures to be issued? 3,000 divided by 10%, it is giving me $30,000. So the value of debentures that I will issue so that the partner gets the same amount of interest will be 30,000. You can also say the value of debentures I want to find out. You will give interest on the value of debentures. So value of debentures into 10% should be 3,000. So the value of debentures that you will issue would be 3,000 divided by 10%. So it would be $30,000. Let's do another example. Let's do another example. A partner has loaned the company $80,000 and the interest rate is how much? And the interest rate is 5%. The company is taking over the partnership, and the company who is taking over the partnership, it is going to issue debentures with interest rate of 10% and wants to ensure that the partner continues to receive the same amount of interest. So what is the current interest that the partner is receiving? He has loaned $80,000 at 5% interest. So 4,000 is the current interest that the partner is receiving. That the partner is receiving. I want to know how many 10% debentures I have to issue so that the partner continues to get the same amount of interest. So 4,000 divided by 10%. So I have to issue debentures worth $40,000 so that the partner will get same amount of interest. So I will issue 10% debentures of 40,000 so that the partner will continue to get 4,000 as interest. So remember, whenever the debenture is issued to the partner, whenever the limited company is issuing debentures to the partner has to receive the same amount of annual interest as he was receiving before the sale of the firm. And you always have to check whether you've calculated the correct value of debentures or not. What is the formula to calculate the value of debentures issued? The interest that he was actually getting divided by the percentage of debentures that you are going to issue. So the first thing that I always need to know is if the partnership firm is acquired by the limited company, if partnership firm is acquired by the limited company, and if there is a loan to partner, then the limited company has to cancel this loan and it has to issue the percentage debentures in such a way that the partners receive the same amount of interest. I hope this is very clear. Okay. Now the part two of this is partnership firm is dissolving. Who is buying the partnership firm? My limited company is buying the partnership firm. That means the limited company is going to take over the assets of the partnership firm and the limited company is going to take over the liabilities of the partnership firm. If the limited company will take over assets and it will take over liabilities of the partnership firm, it is going to do the takeover. It is going to do the takeover at an agreed amount, and that agreed amount will be called purchase consideration. Okay, now look over here. If the value of the assets of the partnership firm is 100,000 and if the value of the liabilities of the partnership firm is 20,000, I'm talking about the book value. So all the assets that is taken over minus the liabilities that is taken over, I will get the net assets that is taken over. Who is taking it over? The limited company. So the net assets taken over, the book value of the net assets that is taken over by the limited company is 80,000. If the purchase consideration is say 120,000, that means a limited company is paying the partnership firm 120,000 for the assets and liabilities that they are taking over. So they are paying 40,000 more to the partnership firm. This 40,000 more is called the purchase consideration. Is called the goodwill. And the amount that they are going to pay to take over the net assets of the partnership firm is called the purchase consideration. Now, whenever I am purchasing the partnership firm, I will have to pass the journal entry for the takeover. So how will I pass the journal entries for takeover? All assets that I am taking over, I will put it on the debit. When I'm saying all assets that I am taking over, that means all the assets that the limited company is taking over, you will put it on the debit side. All the liabilities that the limited company is taking over, you will put it on the credit side. And on the credit side, you will also put the purchase consideration. Purchase consideration, that means the amount which the limited company takes the partnership at. So the limited company will give the partnership firm some shares, face value shares, they will give premium, they may give some cash, and the limited company will also issue some percentage debentures. So all this will come on the credit side. When I am asked to pass the journal entry for takeover, all the assets that you are taking over will be on the debit. All the liabilities that you're taking over will be on the credit. The amount that the limited company is paying to the partnership firm, the purchase consideration will be on the credit. Limited company will issue some percentage debentures to the partnership firm will be on the credit. The difference between the debit and the credit is the goodwill. The difference of the net assets, that means the difference of the book value of the net assets and the purchase consideration will be the balancing figure goodwill. That means goodwill is the extra amount that the limited company is going to pay to the partnership firm for acquiring its assets and liabilities. Are you with me? Or let's do it with an example. I have Lark Field Limited. He has purchased the business of Muhammad, and Muhammad is a sole trader on 1st October. Muhammad's statement of financial position is as follows. It is telling that the assets, so the value of the asset is, book value of the asset is 230, 40, 35, 305. The book value of the current assets is 75. The book value of the total assets is 380. I have the capital account of the partners and I have current liability. The limited company has agreed that they will take over the following values. That means they're going to take over the non-current assets at 305. That is what they are telling. No, they're going to take over at the following values. They're going to take over land and building, plant and machinery, motor vehicle, inventory, trade receivables. So these are the assets that is taken over at an agreed value. This is the liabilities that is taken over at an agreed value. The total, this is the net assets taken over. The total of the agreed values of assets purchased by Lakshmi Limited amounted to 366,000. Lakshmi is not going to take over the cash and cash equivalent. So these are not entered in the journal. Lakshmi Limited has 500,000. Now can you tell me what is this 500,000 that Lakshmi Limited has paid Mohammed for? This 500, this 500,000 is the purchase consideration. So I am taking over the assets and liabilities at 366,000, whatever the company is taking over at whatever value it is over here. For taking over The net assets of 366,000, I am going to pay 500,000. So 500,000 is my purchase consideration, and I am discharging the purchase consideration. How am I discharging the purchase consideration? I am going to pay cash 100,000. I'm going to issue 250,000 ordinary shares of one each. That means the ordinary share capital is of 250,000, and the remaining 150,000 would go to share premium. That means I am taking over the assets of 366,000. For taking this assets of 366,000, I am paying 500,000. The extra money that I paid is for goodwill. For this 500,000, cash limited company is going to give 100,000, and they're going to issue 250,000 ordinary shares of one each. So remaining amount goes to share premium. I want to record the entry to the purchase the business. What is the procedure to record the entry to purchase the business? All assets that is taken over, I will debit. So these are the assets that are taken over. Land and building, 275. Plant and machinery, 37. Motor vehicles, 28. Inventory, 37. Trade receivable, 22. And the extra money that the company is paying to Mohammed is for goodwill. Goodwill is the difference between the NATO, net assets taken over, and the purchase consideration. All assets taken over debit, all liabilities taken over credit, so the trade payables are taken over. And I am going to pay purchase consideration 500,000, and the purchase consideration is discharged. Cash 100,000, ordinary share capital 250,000, balance share premium, and goodwill difference between this. So this is the journal entry to record the purchase consideration. I hope you are with me. Take some time. Record the journal entry for purchase consideration. Can we try this ourselves? Okay. I have to record journal entries in Bridge Limited to purchase Monty's business. Let's see. This is Bridge Limited, and Bridge Limited is purchasing Monty's business. This is Monty's non-current asset. This is Monty's current asset. These are Monty's liabilities. This is all for Bridge Limited, that is a limited company. It was agreed that Monty's assets should be valued as follows. So these are the new values of Monty's assets. Bridge Limited did not acquire Monty's bank account. So I am going to take over everything, but I am not going to take over cash and cash equivalent. I'm going to take over freehold property, that is this. We're going to take over plant and machinery. We're going to take over office furniture. We're going to take over inventory and trade receivables. So we are taking over assets of this value. The consideration for sale was 460,000. And what is this 460,000 made up of? 40,000 cash, 300,000 ordinary shares. Past journal entries in Bridge Limited books to record to purchase of Monty's business. Tell me, what is the value of the assets that is taken over? I have taken over all these assets: 190, 55, 19, 26, 13. The total value is coming up to 303. What is the value of the liabilities taken over? Liabilities taken over is 18. They told me very clearly I'm not going to take over cash and cash equivalent, so I will not take over cash. So the NATO, that means the net assets taken over, the net assets taken over is 285. To take over these net assets of 285, how much are we giving? How much is Bridge giving to Monty? 460,000. So to take over net assets of 285, I am giving 460,000. So what is the value of goodwill? Goodwill is 175. How am I discharging the purchase consideration? 40,000 cash, 300,000 ordinary shares. So 340,000 is gone. The balance amount will go in the share premium, that is 460,000 minus 340,000. 120,000 will be a part of share premium. I need to pass the journal entry for taking over the business of Monty. All assets taken over debit. All assets that is taken over debit at an agreed value. All assets taken over debit at an agreed value. All liabilities taken over credit. Purchase consideration credit. How I am discharging the purchase consideration. Purchase consideration is discharged 40,000 cash, 300,000 ordinary shares, and the balance 120,000 would be share premium. Okay. What will be the goodwill? Goodwill is the difference between NATO, net assets taken over, and the purchase consideration. Goodwill is the difference between NATO and purchase consideration. I hope this is clear. Now you have to now you have to prepare Bridge Limited statement of financial position immediately after the acquisition. So what will you do? You will add this value with this value. You're going to prepare the statement of financial position. Plant and machinery, you will add this to this. Office furniture and equipment, you will add this to this. So you're going to club the assets of Bridge with assets of Monty. So land and building would be 510 plus the agreed value. Plant and machinery 133 plus what I took over at. Furniture 58 plus whatever I took over at. So this becomes my non-current assets. Current assets, whatever value plus the taken over value. And cash equivalent of Monty is 69. From this 69 cash and cash equivalent, I have given 40,000 for purchase consideration. Okay. So this I will have to subtract. This is a very important step. Then I will get my total assets. Now for total liabilities also you need to be very sure. 550 was the shares of Bridge which was already there. You've added more 300 shares which you gave for purchase consideration. This was the share premium of Bridge. I added more 120,000 which was for purchase consideration. Retained earnings stay as it is. Current liabilities of this Bridge and Monty we're going to add. So 39 of Bridge, and what is the current liability of Monty? Trade payables of Monty is 18. And this is how you get your statement of financial position. Are you with me? Now this is your home learning. Pass the journal entry of taking over the business of Alan and Bobby. Okay. by Limited. You have to pass the journal entry. Pause, pass the journal entry, and this is the answer for your journal entry. Thank you.